Good Thursday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your RIA, call your broker. That's what they're there for, to give you advice, provide you with guidance.
All right.
And let me share my screen. If you guys are joining us for the first time, the purpose of this show is to answer any questions you may have on the Market Chameleon tools, data analytics. If you want to discuss strategies, or share with us something that unusual you've seen and you have questions about it, or you want to bring it to our attention, you're welcome to do that. You can put your question on the live chat on YouTube, type it in. Will's watching it, he'll read them back to me. If you want to come on the show and ask your question live and direct, we also provide a link to Zoom. Click on that link, it takes you over to Zoom. Once you get into Zoom, press raise your hand. There's a button there that says raise your hand. Click on that. You don't have to turn on your video camera, but you can, once we let you in, everybody can hear you. You could ask your question live and direct. While we're waiting for questions to come in, what I think we'll do is take a look at the pre-market report, see what's trading pre-market hours, and then I could move on, maybe continue the discussion on implied volatility. We had a lot of good questions yesterday. Some people came over from the Interactive Brokers webinar that we did on Tuesday with follow-up questions. So I think today I'll continue on that discussion unless we get some questions coming in, and I'll take those first.
We had one question outstanding from Rob about the pre-market, D. He was asking, is there a way to filter for the top 10 stocks, I think, by market weight, or top 20, or any number of the top weighted stocks in like SPY? Is there a way to do that?
So not specifically by top weighted SPY, but what you can do is filter by SPY components. I'll do that, and then just sort them by market cap, which is what the S&P 500 is, a cap weighted index. So once you sort them by market cap, you kind of get the higher cap stocks get more weighting in the S&P 500. So I'll kind of go through it today. And well, I'm not sure if I lost you there because your screen looks frozen to me.
I can hear you, but I see what you're saying. The screen looked a little off here too.
Yeah. Okay. So pre-market report. These are stocks trading at pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Got 74 stocks on our percentage gainers list, 48 on our percentage decliners list. From this perspective, looks like we're set up for a slightly bullish bias at the open. I think the CPI number came out today. It looked like it was pretty much in line from what I was glancing at. Didn't really get too deep into it, but the market reaction has been somewhat positive. And I guess that there's some signs that inflation is starting to slow. The rate of increases, right, is starting to slow down. When we look at this report in the pre-market, this includes securities that are trading in a pre-market hours, and it could be any security. It could be a low cap stock, it could be a closed-end fund, it could be preferred stock, it could be a leveraged ETF. And you probably want to start narrowing down this list based on your criteria. The one I usually use in the morning are the S&P 500 companies. And let's do that now. What we're going to do is take this list and narrow down to only S&P 500 companies. And to do that, we have this filter here in ETF. When I drop it down, I get a list of ETFs to choose from. And the top one, SPY, is the S&P 500 ETF. When you select it, so then the list below gets filtered by stocks that are holdings in SPY, right? So here we see 10 stocks made our percentage gainers list, none on the decliners. And just to point out, to make our percentage gainers list or decliners list, there are certain thresholds it has to meet based on volume and percentage move. So sometimes the percentage moves are just so small, we don't really consider it kind of within a range, right? But to get to maybe Rob's question, we do have our most active. So these are the most active stocks that are in the S&P 500. And if you sort it by market cap, right, you got Apple, Microsoft, Google, Amazon. So these are sorted now by market cap over here. Close this. And it doesn't have the weighting listed here. You know, we showed in previous videos where to find the weightings and, you know, more details of the holdings. But the higher weighted stocks get more weighting in the S&P 500 because it's a cap weighted index, right? So if you sort it this way, you know, you don't get the exact weighting, but you see you going down the line, you know, which ones from the highest to lowest. Okay. You could also, if you're only interested, let's say in the top 10 holdings in SPY, you can create it in your watch list, and you could always screen by your watch list here. Okay. So that's one of the ways to kind of do it to get you close to that, to the question I think that you asked.
Yeah, that's perfect. Robert says thanks.
Let me see if there are no questions. What I'll do is navigate to SPY, kind of continue on implied volatility. No questions, Will?
I think there were some questions outstanding. Let me go to the email on volatility. I think one was from Michael about JP Morgan. Let me see if I can find the email. Michael was asking on JPM, please explain exactly what IV 30% rank at 40 means. I don't know what page he was seeing that on. Michael McCrae's on. Michael, if you could mention what.
Yeah, we may have answered that question yesterday. I could go over it again, but we may have answered that question.
All right. Well, Michael's on. Michael, if it wasn't answered, please reply in the chat. Robert was asking, is there a way to get the 30-day IV plotted against events like Fed announcements, CPI, etc.?
Yeah, that's a good question. And let me see. Let me just look really quickly. So the implied volatility, we don't list the events on here because there are a lot of events, right? So if I put in all the events that you can imagine, there's almost some kind of economic event coming out every day, right? If we look at here on the morning report, if we look at just today's economic calendar, you can see that there's always every day there's some type of an event. So to list all of these every day on a plot would be too much.
And by the way, 3 years ago, a CPI number, FOMC didn't really mean much, right? People didn't.
Exactly. It's like, exactly. Nobody cared about the CPI number. Nobody cared about, you know, a lot of these numbers were really at 0% interest and everything was going smoothly. Those numbers came out, but they were not very impactful. Now they're much more impactful, right? So, and we talked about that, how to organize data where, you know, you try to take out the data elements that are the most relevant to today's situation to try to start gauging like what the range of possibilities in implied volatility or movements, whatever. So we don't plot that on the chart. Let me just think real quick. We do have, let me just see here on it. I know on the event driven screener, what we do has, if you do pick like an event type, let's say the FOMC, it goes back the last 12. Let's just look at SPY. It goes back the last 12 and shows you how the stock reacted around the FOMC meetings. That's not the implied vol. Another thing, look, one thing you can do if you have the dates, and you could get those dates pretty easily, I think. If not, let me know. But if we go here to the historical data, here by day, you could download this. We could see these are the dates, and this is the implied volatility end of day on that date, right? You have the option volume, stock volume, breakdown, call, put volume, open interest. So if you downloaded this data and had the dates in Excel to match up with the CPI, you can kind of start manipulating, because once you start taking data, there are going to be many different ways you could analyze, right? You start out very simple, and from very simple you start making adjustments, looking at this, looking at that, so it then builds up. But a quick way that I could think of off the top of my head is download this data and get the dates the CPI numbers came out, or the Fed announcements, and start comparing it this way.
Perfect.
So, yeah. That's a good question. Maybe I'll work. Let me think about it, how to make it an easier analysis from here. Especially now, it's like you said, well, it's more relevant than it's been. So let me think about it. But right now, this is the way. One way I could think of it. You could get started today.
Hey, D, we had a question from Mike popped up, and I'm assuming you were on an options chain maybe at the time. He was asking, what does the red and green color represent under the Theo column on the option? He said on the options chain. So,
yep. So, I'll go out a little bit further. So when this is an options chain for SPY. On this side we have calls, on this side we have puts, and you have the call bid, the call offer, put bid, put offer. And when we were looking at the options, it's very hard to just from looking at the option, is this option potentially overvalued, undervalued? Is it in line with the rest of the options? And to kind of get a sense, to get of where their price versus a theoretical value, we run a model to create a theoretical value that you could kind of input to point things out. And the default model is the following. It takes the at the money option and starts from there and says, okay, let's use the at the money implied volatility and start running a regression through the strikes going up, and run a regression model through the strikes going down to start getting a best fit curve. Okay, so not a best, because remember when we look at the implied volatility smile here, let's see how it looks. Let's look at skew. Click on that. So here's an IV smile graph, So you see here, this is what the implied volatilities look like across strikes, right? So you start at the money, they're kind of going down, then it kind of loops back up a little bit here, and the implied volatility is going up. But if you look at it, it's a little bit choppy. It's not like very smooth, right? And theoretically, you would think it's smooth. It shouldn't be jagged. Like it's either, climbing up slowly or quickly, but it's usually smooth because the market makers, dealers' quotes would be more smoothed out. Because otherwise, you're putting in, offsets everywhere, right? You're putting, offsets to the downside, offsets to the upside with different strikes. It wouldn't really make sense to stream a jagged implied volatility curve, right? So a dealer, right, what are they doing? They're streaming a volatility curve, a probability distribution, right? Think of it as they're running a probability distribution and they're streaming it based on inputs from wherever the stock price and whatever they have it pegged to. So when we look at if we take the at the monies as the starting point, right? So we take the at the monies, that's the starting point, and then we start sloping up and down, okay? And we're going to run a regression to smooth out the curve, and by smoothing out the curve, wherever it's jagged, right? Wherever it's jagged, it should show up. Okay. So let's see if I could, in SPY, it's, these markets are very tight. But let me take a look. Where was I on January 13th? So you could see here, we started probably at the money. So we had it a little bit lower because we're using the surrounding data, and the reds are showing up if our Theo that we ran through our model is below the bid, it lights up red. Okay, just as an indicator, well, our Theo was below the bid. If our Theo is above the offer, so it looks like, or matches it. So this one's matching it. It's not really, but it just lights up. It's on the offer. Then it lights up green. And again, this is just theoretical value based on some model, right? But this model that's defaulted will take the market prices at the monies and start running different regression analysis on it. So there's like multiple regressions to get the slope. Okay. And if something's very away, then it'll start really popping. So these are very close. But the idea is if something's very away or very jagged, it will pop up. Like, let's take one, or maybe, let me see if I could find one that's not like higher market cap stock that may stick out. Here, let's take a look at like Mara. So we'll see if something sticks out. Well, these are pretty tight markets too. So why are these sticking out here? These are all green. These are all mostly red. The reason is that also comes into play is that we put in a theoretical cost of carry, and our cost of carry.
I'm sorry, I didn't quite catch that. Could you please say that again?
Is that you?
That's Siri.
Siri. Look at Siri.
Yeah, trying to answer the question. Why would our calls be high and our puts be low? Well, our model always assumes that the stock is easy to borrow. Okay, so it doesn't give it a hard to borrow rate. Well, why does it do that? Why does it assume it? Because if we put in an assumption in there, if you put in an assumption in there, and I just said, okay, well, what if the market assumes 10%, put in 10%. If we did that, then you would not be able to tell that this stock is hard to borrow. The only way to tell is to see that, well, the calls are lower than the puts, right? The calls are being offered lower and the puts are being bid up. Then you can kind of tell that there's an implied hard to borrow rate. All right, so that's the insight you would get right away from looking at this. All right, so if there's like something here, let's do it this way.
Hey, D, well,
Yeah.
while you're clicking around, Rob was asking, what screens Dimitri go to that show bearish and bullish?
I don't remember where it was. Do you?
I
Bearish and-
don't. I can go back and look at the replay and figure it out for tomorrow. But
Yeah,
right now we're live.
I don't know. Yeah, I don't recall like not doing it today. But here's a synthetic where the synthetic long is offered at a discount. Basically, if you're buying a call, selling the put, it's offered at a discount relative to where the stock price is. And here at AMPX looks like a big discount, right? So I'm going to click on there, and this is what it would look like. So here, what this is saying is, if this stock AMPX, right? If this stock AMPX was not hard to borrow, right? Was just a regular stock that.
I'm sorry. I was able to click back. It looks like you went to the unusual option report, and there it shows bearish and bullish in market sentiment. You clicked over the unusual option report.
Okay. All right. I'll go back to that
All right.
after this. So what this is green and this is red is saying that if this stock AMPX, right, was not hard to borrow and we just input our interest rate. So our interest rate assumption is basically looking at the Fed funds rate curve. Okay. So we're looking at the Fed funds rate and seeing where those interest rates are. Then we run that curve and we follow the Fed funds rate because in the US, if you're trading in the US and use US brokerage, usually that's the interest rate that they're pegged to usually. Okay. Some people say LIBOR rate, but for the most part, it's the Fed funds rate that your borrowing costs are usually pegged to. Okay. So we're looking at the Fed funds rate, running that interest rate, and we say based on that interest rate, if this stock was not hard to borrow, then the put call parity would be 230 in a put, 74 cents in a call. But you could see here that the call is offered below, the put is off a bit higher, meaning that there's a hard to borrow rate in there. Somebody in the markets are paying to get short. Okay, that means there's a demand to short this stock, and they're willing to pay to borrow this stock or to pay synthetically to get short this stock. And the only way really to observe it is if we ran an assumption that it's not hard to borrow, and by running that, we could right away see like, wait, something is wrong. Why are the puts bid up, calls are lower? So that Theo right away is giving us insight. Something here is off. Okay, so that's why we're doing it. So you could kind of visually see right away something is off. What's going on? Now we could have a wrong dividend assumption too, right? Because some of this we're based on assumptions and dividends themselves. Until the company tells you or declares it or tells you have to estimate it. So we don't know if a company that's paying the dividend in the past. We don't know if they're going to continue to pay the same dividend, if they're going to raise it, if they're going to lower it, eliminate it. We don't know, but we have to kind of look at their historical patterns and say if there's some kind of pattern to what they've been doing, then we estimate that going forward as well. But that estimate could always change or be wrong or whatever, because there's no other way until the company tells us exactly their dividend schedule and exactly the amount they're going to pay. The only way to do it is to estimate it, because the option prices do estimate the dividend. So that's something to keep in mind. And it will be reflected in these Theos, right? Because the Theos are trying to point potentially something happening in the markets that you would not be able to visually just see without running some kind of a model and comparing your model to the market prices. Okay.
That's great, D.
Unusual option, yeah. So I went to
the, I sent Robert the link so he was able to find it.
Okay, yeah, it was on the on this unusual options volume report, and it's, yeah, I think it was here. All right, so we're right up at 9:30.
We did have an interesting comment by Michael McCrae. I know he said this before. It is somewhat of a great comment because well, I'll read it to you. You guys should go on social media to gain broader exposure. You have one of the best, if not the best analytical sites on the internet, yet I rarely see more than 30 watching. Maybe I'm wrong. This is something Dimitri and I do talk about. We'd love more people to watch and more people to learn from Dimitri. And any suggestions anyone has to broaden our exposure, we will definitely take. We do put it out on Twitter, Facebook. Neither Dimitri or I are internet TikTokers or sensations, or, you know, we're not really personalities. So maybe that could be part of the issue. I'm not exactly sure, D, but
we have a lot of some people watch it later, not live, but I think that our platform, when you think about like what we're doing in our analysis here, it goes a lot deeper than usual. Like what you'll see is, and we're not professional marketers, by the way, so we don't know anything about our if you go look at a lot of these companies, their expertise lies in marketing, right? Digital marketing, SEO, they a lot of them content marketing, they come from that background. We have absolutely no background in that. But what we would say is our platform, to get to here, you probably would have had to go through all those stages, you know. So those people who are doing that, you know, they're a lot of them, and you know, we talk to people in this industry, a lot of them would not be at the level to understand some of this. You know, they wouldn't, you'd be surprised, but a lot of people don't even what they think implied volatility is, and they're convinced they understand it, and they're trading based on what they think they understand, you know, is based on false assumptions. So that's why I think that we would not, and people tell us this, you know, even what people would do, just if you want more, you have to keep dumbing it down. But at some point, if we dumb it down to, I think you start losing value, right? You can't.
Yeah, and it's 30 to 40 people watch it live, but people are also watching on our platform, which doesn't show up as live. And we also, by the end of the day, there are hundreds of people who watch the video. So it is going out and helping lots of people. But again, any suggestions someone may have, we listen for sure.
Yeah. So look, everyone, thanks for joining. You know, stay safe out there. Have a great trading day, and we hope to see you tomorrow. I know it's at 9:30 already, so we're going to let everybody go.
Yep. Great job, D. Thanks so much.